If you have decided to transition from being a saver to an investor because you're completely convinced that if you keep all the hard-earned money safely under the carpet in your house, it's not going to help you in long-term wealth creation. And you're also convinced of the fact that equities can beat inflation and gives good return in long term, but you're flooded with a choice and really confused how to start as a beginner. In this case, this video is for you. Here I am going to explain what are the 3 ways to invest as a beginner in equity market. So watch till the end, and if you like, don't forget to subscribe this channel. First one, direct equity. This is a simple process where you are going to open trading and demat account with any brokerage and link your bank account with it. You are a sole decision maker here. What to buy, when to buy, how much to buy, which sector to take exposure, you are going to decide. There is nobody else here who is going to manage your portfolio or pick the stock for you. So for a smart investor, this is a cost-effective way and there is a huge profit potential. But if you are a beginner in the stock market, will this method suit you? Probably not. Let me explain you why. If you do not understand some technical fundamental analysis or adopt a bottom-up or top-down approach, for example, you know how to analyze economic specific risk and sector, industry, as well as a company that you're looking to invest, you may be trapped at the end. There are different criteria which are going to be applicable in case of momentum stock, growth stock, value stock. If you keep only PE as the single best criteria to pick the stock, you may miss huge opportunity in growth stocks. I remember I have seen MRF at 16,000 and I was really thinking whether this commands this much price, and now the same MRF has hit 1 lakh rupees per share. So for the growing companies, as long as they have that growth potential, PE may not be a criteria at all. And even if you take ROC or return on capital employed, there are many ways that this metric also can be window dressed or influenced. Second is mutual fund route. This is where investors' money is pooled and it is managed by a professional. The idea is when you are taking expertise, the risk can be managed better. See, when somebody is taking a call on behalf of you, picking the stock as well as managing your portfolio, there is obviously going to be a cost or a fee associated with that. This is what you have to pay for his time as well as expertise. I believe that as long as you want only blue chip, maybe there is no need to look at mutual fund, because blue chips by nature, they have huge trading volumes and there is a consistent demand and the price pattern, etc. But when you are willing to take little more risk and go towards having exposure in small and mid cap, it may not be the case. Most of the information pertaining to this sector is not publicly available. So it's difficult to make a decision as a retail investor like I and you. What is the best way possible? Take mutual fund route. Because when a fund manager goes with a huge asset backup or AUM, he definitely gets the privilege of knowing what is happening in the industry, and when he takes a call, you are also going to get benefit out of it. There are 2 ways of picking mutual fund. One is direct plan and another one is regular plan. If you know how to pick mutual fund, direct plan is the best because you are directly placing your order with fund house. If you do not do that, just invest and forget is your mantra, then regular plan is better because you are going through a commission agent who again charges some commission and manages your portfolio and places your call. Now, if you want to go for direct plan, what are the criteria? You have to look at fund managers' perspectives and investment philosophy. It's very easy. You have to keep observing what he says in all the interviews because he's a person who is taking control of your portfolio. If your investment philosophy matches with him, then it is a clear go. And also, expense ratio, lower is better. Asset under management is one more criteria. Huge asset under management in any fund denotes higher level of investors' confidence in it. So go for something with huge AUM, less expense ratio, and where your investment philosophy matches with that of fund manager. Third is ETF, exchange traded fund. This is one of the passive way of investing. ETF usually mirrors certain asset class or closely tracks stock market index. For example, you can have Nasdaq 100 ETF, or it can even track certain themes like artificial intelligence or commodities like gold. So first finalize ETF based on what you're looking for, where you want to have that passive investment. Is it any asset class like gold, or is it any particular stock index? Once it is done, then go to the next criteria while choosing ETF. That is, look at the trading volume on daily basis. The biggest risk of ETF is liquidity. Means you are not able to exit or sell it at the price and at the time that you want. If the trading volume is good, when you are observing at any point of the trading day, that means you are not having so much of liquidity risk. Second one is asset level or asset size. This is also important because higher the asset size is always better. It shows that many investors are confident about it. They have shown interest before you in that ETF, right? So go for something with highest asset size. And the last one is the tracking error. Means ETF is an instrument which mirrors or tracks certain commodity or stock market index. So it has to closely track if there is a gap between the price of ETF and what it is tracking. Then it is not a good sign. There is something that you have to go and unearth to see where is the actual problem. If the tracking error is less, then that ETF is better. I hope by the end of this video, you have understood what are the 3 ways to take exposure in equity market. Now, if you like, please subscribe the channel and share it with someone who needs it.